A very good evening, friends. I welcome you all to this webinar on related parties and the aspects that are being covered.
So it's less audible.
Audit, disclosure, and compliance. Are you able to hear me? So I welcome you all to this webinar, which is the 110th program of AASB for this council year. And today's topic is the related parties, audit, disclosure, and compliance. Friends, I am Sanjeev Singhal. I am the chairman of the Auditing and Assurance Standard Board and the Public Relation Committee, and vice chairman of the Sustainability Reporting Standard Board. On behalf of my vice chairman, CA Vishal Bhai Doshi, I welcome you all to this webinar. And I'm also happy to share with you that this is the audit season which is going on. And AASB has launched an expert helpline whereby you can ask your queries pertaining to the statutory audit of corporate as well as non-corporate entities. And we have 50 experts who will be more than happy to answer your queries pertaining to audit. And this service is free of cost. Please feel free to write your queries that you may have in this regard. And also, we have recently come out with a checklist on auditing standard in PDF, Word, and Excel format, and also working paper templates in PDF, Word, and Excel format. Please make use of it. These are illustrative, and please apply your judgment while using these. Friends, with this background, let me come to topic for the day. We are going to discuss a very important aspect on related party, how the audit should be done, what are the disclosure requirements, and how compliance should be adhered to. Friends, we know that the related party transaction are to be examined with an added, flair for the auditor mindset that whether the requirements are met, whether the transactions meet the eye, whether an independent person will say that these transactions are at arm's length or not. These are very, very important aspects. And in many reviews by the regulator, these type of transactions tend to be questioned. And hence the documentation side from the auditor side should be very robust, and the audit should also be very robust. To discuss this topic, we have with us CA Raghav Singhal, who is our guest speaker. And I'm very happy to talk about our keynote speaker for the day, CA Chandrasekhar Chetleji, respected Central Council member from Pune. And why we chose him for this topic, he's also the chairman of the Ethical Standard Board. So related party, when we talk of ethics, we talk of compliances, we talk whether it meet the test of being independent or not. So Chandrasekhar Chetleji looks at, he's the overall in charge for the ethics, for the code of ethics for the chartered accountants, and a very learned personality, has diversified into many fields. He has handled the responsibility of the chairman of the Corporate Law Committee and chairman of the Direct Taxes Committee in the past, and now very successfully steering this Ethical Standard Board. Before I invite him, I would also like to thank CA Tarun Gupta, who is the chairman, Karnal branch, who will be the moderator as well as who is the host for this webinar. Tarun Bhai, thank you. Thank you very much for being there. And with this, now may I request CA Chandrasekhar Chetleji, our keynote speaker, to deliver his keynote address. Thank you, and over to you, Shekhar. Shekharji, please go ahead.
Well, thank you, Sanjeev Bhai. Auditing and Assurance Standard Board of the Institute is organizing various seminars on the topics emanating from auditing. As far as standard setting process is concerned, that also they are vigorously taking up. They are making innovations to suit the modern day situation in audit. And once the audit has become on a computer base, having evidence on record has become more and more tricky. But then we have to find out the ways and means, because this is the way the auditing profession has to go. Friends, amongst various other transactions where you have to rely merely on paper evidence, and the transaction value has to be asserted from the documents offered. Relative Related party transactions afford some distinct challenges, because the auditor is not only expected to look at those transactions at transaction value, but also to slightly go behind that and consider whether the interest of the enterprise has been nursed. In case of Caro, there is a specific question whether the related party transactions are at arm's length. In case of taxation, all these related party transactions are under the scanner of tax officer, and there are various provisions in tax law that wherever you are paying in excess of the arm's length price to related parties, then to that extent that is not considered as an expenditure. So various challenges are surrounded in this particular category of transaction, that is related party transactions. And we have to understand the nitty-gritties, how to point out. In fact, if you consider the standards on auditing relating to documentation, that also plays a vital role. Because what I've seen in case of various auditing entities, these documents are also not prepared very diligently. So, friends, before we start the audit, we should have list of associated enterprises available with us. We should go through the registers of companies where the associated parties, the related parties of declaration by the directors are given. And not only you should go through it, but also you should have evidence of having performed these particular steps. And there are various other aspects relating to this related party transactions, because after having understood who are the related parties, not only in certain circumstances you have to disclose their names, the transactions, and various other aspects, but you have also to take a call whether these transactions are at an arm's length. So various aspects are involved in it. And today we are very fortunate that Raghav Singhal would be dealing with this particular topic. He is a young and learned chartered accountant. Before we started this webinar, I asked him whether his surname has got anything to do with his selection as a faculty. And then I was told that he is not related party to the chairman AASB. His surname appears to be same, but otherwise they are not related. So I was happy. His selection was made on merits and not on related party relations. This particular webinar is also being coordinated by a young and vibrant chairman of Karnal. I'm informed that Karnal branch is a very vibrant branch from NIRC. I had no occasion to visit, but Sanjeev Singhal keeps on telling me about the functioning of Karnal branch. And today, presence of the chairman of this branch also will add a flavor to this particular seminar. So all of us are eager to know about the nitty-gritties and audit procedures. And after knowing how to do the audit, what are various reporting requirements? Because if you consider in case of listed enterprises clause 2043 of SEBI agreement, these related party transactions are more significant and are more under scanner by regulators. That is also dilated by Chairman AASB. So let us try to understand the importance of this particular provision and also the auditing procedures and reporting requirements. So with these words, I hand over to the faculty for the day.
Thank you so much, Shekharji. Thank you so much. And may I now invite the moderator, Tarun Gupta, to kindly say a few words, invite the faculty. Thank you.
Hello, everyone. Hello, good evening, Ji. Good evening, all. In the presence of CA Sanjeev Singhal Ji, Chairman, Auditing and Assurance Standard Board, CA CVG, Chairman, Ethical Standard Board, CA Vishal Doshi Ji, Vice Chairman, Auditing and Assurance, CA Raghav Singhal Ji, our guest speaker for today's webinar. I welcome you all in the today's webinar on related party audit disclosure and compliance. Related party audit disclosure is a very important topic and it's somehow untouched topic जिसको हम normally इतना consider नहीं करते. इसके ऊपर normally webinars और सेमिनार भी कम होते हैं, मतलब बट ये एक बहुत इंपॉर्टेंट टॉपिक है और इसके ऊपर डिटेल में और डेप्थ में नॉलेज के लिए टॉपिक पे अवर गेस्ट स्पीकर सीएस राघव सिंघल जी हमारे साथ हैं. चार्टर्ड अकाउंटेंट विद 10 years of experience in conducting statutory audits under Indian GAAP, Ind AS, and US GAAP, approx 4 years of experience with KPMG, and 3 years experience with Grant Thornton. Currently, he is working as a manager assurance advisory at Pyrene Services, leading their New York DC. Have lead numerous private and listed statutory audit across multiple industries, ranging from automotive, hospitality, FMCG, retail consumer goods, diversified manufacturing, IT, and healthcare. We are so lucky that Raghav Singhal is with us. Now, over to you, Raghavji.
Thank you so much, Tarunji, Sanjeevji, and Shekharji for giving me such a warm welcome. I'll just quickly present my screen. And for Shekharji, my surname and Sanjeev sir's surname is completely at arm's length price. So that is there. I am just, if my screen is visible. Right. Is my screen visible, moderator ji?
Yeah, sure. Visible.
Right. So, hi, friends. A very good evening, a very good afternoon to one and all. And this topic, related parties, audit disclosure and compliance. When it came to me, I was actually very excited because this is one topic which is actually the RPT universe is very wide. Like Shekharji said, that a lot of regulators are actually constantly, trying to improve and improvise the laws, the compliances, and etc. And it is also very important from an audit standpoint. So allow me and thank you so much for giving me this opportunity to present this topic in front of everyone. So some considerations that we would be talking about today will be, one is, why are related parties critical? What is the criticality of related party transactions? What stakeholders are actually interested, and what past scandals have happened in the world that have actually, involved related party transactions? Some fraud related to RPTs, routes of related party compliances, understanding the related party as per Companies Act, understanding the related party as per SEBI, then Ind AS, and then the audit of related parties and disclosures and etc. So moving on, friends, firstly, let's talk about criticality of related party transactions. Whenever this word comes into the picture, related party transactions, why is it that the auditor should be really wary of this word? The regulators are wary of this word. The management itself is wary of this word. Why is it not a normal transaction? So the reason is that when let me just give you an example. So let's say that today, if I ask you that, okay, you need help from somebody, who will you turn to? The first person you will turn to is your family. It's people who you are related to, your parents, your siblings, your children, maybe your cousins, maybe. And why will they be in a position to help you? It's because they're related to you. Some unrelated person or some unrelated entity may not be that interested in helping you out in terms of situation. That is the main reason why a related party transaction, is so critical. Because when we say about related party transaction, it refers, let me just put the laser pointer, it refers to an arrangement or a deal and I'm talking in a very layman language right now, between two parties who are joined by a pre-existing business relationship. So there is some relationship already between two parties which can be abused, which can be misused, which has the tendency of being, channelized in unusual manners. And that is the reason why this topic becomes really critical. So the underlying assumption in case of a related party is that transactions are controlled and influenced by parties to the transaction. So when I say underlying assumption, it means that when we come across a related party transaction, we assume it. We don't, before even any kind of verification, we assume it that it must be an influenced transaction. And we see it from that lens. And that is the reason, and this assumption is not made in case of any unrelated party. So the terms with a related party in comparison to an unrelated party might be very different. And that's the reason we see it from the lens of scrutiny, right? Another thing, generally, whenever we are speaking about related party transactions, more or less we are, the first thing that comes into our mind is price or transaction price, or, the sales or purchases or these kind of general transactions. But let me tell you, friends, that price is not just a related party transaction, or it's not just, it's not the sole term that, the payment conditions. Credit periods can also be misused. Unusual benefits can also be misused. So let's say that a company A is giving more credit period to company B to pay their sales. So just to inflate their own assets, just to inflate their own receivables. So that can also be a credit related party transaction. It's not necessary that only a price or a sale is a related party transaction. So how related party transactions affect financial statements? They are of interest to variety of stakeholders, and because of this criticality, because of this, and I should say one more thing is where, these transactions are very easy to hide from a company perspective. And that is why a variety of stakeholders, including regulators, have a very high interest in this topic. Now, moving on to what stakeholders are interested in a related party transaction. So, each stakeholder might have a different lens. So, for example, if I talk about an investor and shareholders, which are you and I, right? So, if I tell you that, okay, let's say that today an IPO is coming, and, I know that this is, these years, last couple of years, we've seen a lot of demat accounts open, and a lot of youngsters like you and I get into the, the investing through so many applications and etc. So, let's say if I were to tell you that you are an investor and you want to put in money in an IPO of a company. But if you go and see the IPO, the red herring prospectus or the prospectus that the company has provided, the financial statements in that prospectus, if you go and see those financial statements, you just notice that 80% of the transactions are with related parties, or 90% of the sales are with related parties. Would you be interested in investing or your hard-earned money in those? I don't think so. I will not do it. So there are a lot of stakeholders and shareholders who are actually interested in related party transactions. Similarly, regulators and government agencies like SEBI, they are the guarding members of the market, and they are concerned with ensuring fair and transparent business practices and to prevent fraudulent and unethical activities. Auditors, we who are auditing the financial statements are absolutely interested in these transactions, because we actually guard, and we are actually responsible for providing an assurance on something on which the country is investing, right, on the financial statement. So it is very important from that standpoint to ensure that transactions are properly disclosed and accounted for. When I talk about creditors and lenders, would you or any bank or a financial institution give lend money to any unstable company or a company who has most of its transactions with related parties? Because they are concerned about actually evaluating the credit worthiness of that entity. So they will only be providing loans, credit, etc. When they are sure that a company's financial stability is there and they have the ability to repay the loan. How will they come? Because if they are interested in seeing the related party transactions. Then there may be other stakeholders like employees and employee unions. Now, there may be a situation, let's say that, company A is, so employees may also be interested in, related party transactions if these could impact employee compensation or benefits. So let's say that because of, a company A is actually, using its subsidiary employees and paying high level of remunerations, but they are actually not concerned, or they're not concerned about the well-being or the development of their own employees. So those employees can actually have an issue in that. Or maybe you see that in one of the appraisal cycles, the KMPs, the key managerial persons, are actually enjoying a 50%, 60%, 70% hike in their compensations year on year, but the general employee band of the company is just, let's say, 5% or 6% increment. So employees can also be interested in seeing that what the companies are actually doing, transacting with the related parties. And then general public, of course, if they believe that the transactions could indicate questionable practices, lack of transparency or potential wrongdoing. So there are a lot of stakeholders who are actually interested in such related parties. Now, moving on to some frauds related to related parties in the past. So there have been many major scandals in the world. And I've only picked up those very few that most of us may have heard of, right? these frauds, actually a part of it happened because they were actually, involving related parties. Moderator ji, I'm so sorry. I want to just ask you one. Is this, like, I can see one band on my, yeah, I think this is gone now. Yeah. Right. So moving on. So I'm saying that why I have included this slide is because just to tell you that a lot of major frauds have actually happened due to related party transactions. So some examples in the past have been like Enron, right? Now, Enron, everybody know the Arthur Anderson case. So one of the things that they did was that the company created some special entities which were actually controlled by Enron's own executives. And what they did was that they used to move their, defunct debts and liabilities and offload them from the main company's balance sheet into these SPEs, just to show a very rosy picture about their own entity to the public. Tyco International, a very, very big conglomerate, right? Involved in various entities, so they were found to have engaged in unauthorized and excessive related party transactions like bonuses and loans to their directors, loans to their, bonuses to their key managerial persons, etc. WorldCom, a world major telecommunication company at a point, was engaged in fraudulent related party transactions because its CEO borrowed money from the company to cover personal loans. And the same happened with Adelphia Communications as well. Adelphia also, the family members of the CEO actually borrowed money from the company and used it from the personal expense. So these are all related party transactions, which actually, because of their being hidden or because of the regulations not being so stringent at that point in time, because of the auditors not placing so much of importance on these kind of transactions, actually resulted into some major frauds and scandals that actually rocked the entire world, even though these frauds emanated from the US, but it rocked the entire economies of the entire world. So that's how important related party is. Now, moving on to the roots of related party framework in India, right? So since we know that how important related party is, you can actually see, and these are only few regulators that I have actually mentioned here because of lack of space. There are many, many more, like, there is Competition Act as well, which talks about their, related parties. The roots of related parties framework in India, if you see, Companies Act talks very strongly, is the primary legislation governing. Section 276, Section 188, Section 177, all these acts talk about related party transactions. Various forms are required to be filled under this act. SEBI, like Shekharji mentioned, Sanjeevji mentioned that SEBI regulation 23 of these guidelines actually outlines the requirements for related party transactions. Then your accounting standards, AS 18 in the past, Ind AS 24 right now, provide guidelines on the disclosures and accounting treatment of related party transactions. Then there are other SEBI regulations like prohibition of insider trading. They also address related party transactions. Then the banking and the insurance sector, then banking and the insurance regulators, RBI and IRDAI, they have their own guidelines, own set of rules, relating to related party transactions to maintain the integrity and stability of their system. And then, of course, our own income tax department, income tax laws, they are related. There are so many things like domestic transfer pricing, 40A2, they have implications on income tax purposes. So, so my only point in presenting this is that, almost all major laws in India, somewhere or the other, actually refer to related party or related party framework. And out of these three, what we would be covering today would be Companies Act, Accounting Standards, which is Ind AS 24, and SEBI Regulation 23 in brief. These are also very, very, very wide, right? So moving on, let's talk about the compliance part first, right? So let's try and understand first what the Companies Act actually, says about related parties, what are related parties, what come under the ambit of Companies Act. So Section 276 defines the related parties, right? So the first, category is director or their relatives. So relatives include your spouse, your parents, your, children, your siblings, and any others are defined in the act. So, I don't think we need to give an example of the directors. Any board of director or their relatives, right, are there. KMP or their relatives. Now, if you see directors, now it's moved, it's widening, the ambit is widening. Now, any key managerial person, right? So KMP can be any CEO, CFO, a company secretary is also a key managerial person, or any other person acting in the managerial capacity by whatever designation or by whatever name the company has provided them. So he is also KMP, and so that person is also a related party, and any relative of that person, as we saw here, is also a related party, right? Firms where directors or managers of the company are partners. So some firms where either the director or the manager is a partner. For example, if Mr. C is a director of company Z, a director of company Z is a partner in ABC firm. So ABC firm is actually a related party, right? Moving on, companies where directors or managers hold shares. So if the director or manager of the company that we are talking about, they hold shares in any other company, right? Now, when we talk about private company, the law says that if a director or manager holds membership or directorship, irrespective of the percentage of shareholding. But in a public company, if a director or manager holds more than 2% of the share capital, then that company would be a related party to the company that we are talking about. So, for example, if Mr. D, a director of P company, owns more than 2% shares in XYZ Limited, then XYZ Limited actually becomes a related party of company P, right? Entities following the advice of a director or a manager. So, so let's say that you have a company, and any director or manager of the company that we are talking about is actually advising some other body corporate or some other company, and that other company is actually following that advice, and that other body corporate actually becomes a related party of the first company. So a company or entity whose board of directors or managing director or manager typically acts as advised by a director or manager of the first company, right? So that both the entities become related parties. Persons advised by a director or a manager. This was entities advised. Now we are talking about persons advised. So any person who's actually advised by a director or a manager also becomes a related party. Companies linked through ownership or control. Now, a holding subsidiary or associate company, these are companies linked through ownership or control. So let's call it a group. Let's call it an ownership group or control group. So all the companies in one control group are actually related parties of each other. So even a step down subsidiary. So for example, if I talk about, if company S is a subsidiary of T and T is a subsidiary of U, right? So all three companies are related parties. So subsidiaries, co-subsidiaries, your step down subsidiaries, associates, all these are related parties to each other. And then of course, any other person as may be prescribed. So this is the definition that the Companies Act actually speaks. Now, when we come across the transactions covered under Section 188 of Companies Act, right? So Section 188. So we saw that there was definition in 276 now, which defines what is a related party, not a related party transaction. So Section 188 takes you to that ambit that what transactions are actually covered under, which come under the ambit of related party transactions. So these transactions, if made with a related party that we discussed, become a related party transaction. So what are the transactions? Selling or otherwise disposing of or buying property of any kind, right? So if the company is actually selling or disposing of can be scrap, disposing of can be transfer as well. So if a company is, let's say, transferring any property to its subsidiaries, not selling, not charging any price for it, would also become a related party transaction. Or buying a property of any kind. Sale, purchase, or supply of any goods or material, any. It does not, there is no classification, there is no distinction. So a sale, purchase, or supply of any goods or material is a related party transaction. Leasing of property of any kind. So we see that a lot of times, companies actually are taking machinery on lease, are taking equipment on lease, are taking, something else on lease. So leasing of any kind of property from your related parties that we discussed also becomes a related party transaction. Now you must be wondering that, okay, these are goods, etc., but there is no mention of services. So here it is: availing or rendering of any services is actually also a related party transaction. Appointment of any agent for purchase or sale of goods, materials, etc., is also a related party transaction. So you made the commission paid to that agent, or any sort of transaction would come under the related party transaction. Underwriting the subscription of any securities or derivatives thereof of the company. So basically, when we talk about underwriting the subscription of any securities or derivatives thereof of the company, means that any firm who when you go into an IPO, when you go into an FPO, so they provide their underwriting services for any subscription of securities. So those transactions are also related party transactions. And the main reason basically is because these transactions are very intimate to the company, right? So generally, these can be actually covered with a facade, and that is the reason that they are covered. Appointment of placement of related party to any registered office or place of profit in a company or its associate or subsidiary. So let's say that a company, for example, appoints or places its own director, which anyway is a related party, to any subsidiary, to in a place of profit in a subsidiary, or let's say head of any committee in a subsidiary or anything, and then the remuneration paid to that director from the subsidiary can be a related party transaction. So these are the transactions that are covered under Section 188 of the Companies Act. Now, we've talked about the what are the related parties. We've talked about what are related party transactions with examples of each and everything. But there is an approval mechanism also under Companies Act. So the Companies Act says that there are two sets of approvals that are required under Companies Act. One is Section 188, and then we will be moving on to 177 with the Audit Committee. So why are approvals extremely necessary? The reason is because everything should be visible to all the key stakeholders, and that's the reason. So the Companies Act lays down two sets of approvals. One in Section 188. So we are talking about 188 right now, which primarily talks about approvals from board of directors and approvals from shareholders. So firstly, let me cover this side, which says that if a transaction is in a normal course of business if a transaction is in a normal course of business and on arm's length price, then there is no approval required from anybody, no board of directors, no shareholders, nothing, right? And the reason is because it is in the normal course of business and a fair price. But this obviously has to be tested by you, by an auditor or by the bodies and etc., right? Which we will come back on when we discuss the auditing part. What does arm length mean? Means a transaction between two related parties that is conducted as if they were unrelated. So there is no conflict of interest. So let's say that, for example, if you are testing sales on arm length basis, so what you can do is, you can take the sales register of the company and you can see that if there is one particular product which is being actually sold to a related party of the company, and the same product is actually also sold to some unrelated party. So what is the price difference? Why is it if at all there is a difference? If not, then it's at arm's length price. In ordinary course of business, the term ordinary course is not defined in the Act. However, the routine business activity of the company, or which is a common trade practice in the industry. So if a transaction is at a normal course of business and on arm's length price, no approval from board of directors or shareholders. Now, let's come to, transactions which are not in the normal course of business or not on arm's length price. So even if one condition is missing, if they are not on normal course of business or are not on arm's length price, then we would be requiring two sets of approvals. First, we would be requiring board of directors approval on all transactions, irrespective of the amount, etc. So all transactions requires approval through board resolution. And we would be requiring a shareholders approval as well, but shareholders approval through resolution would be required if the limits which are mentioned in Rule 15 of MBP rules of Companies Act cross. So only if in those cases shareholders approvals will be required. So board of approvals in all cases, shareholders approval if it passes the limits, and both these only if the transactions are either not in the normal course of business or not on arm's length price or are not on both. Now, shareholders approval, even if it crosses limit, there is one exclusion, and the exclusion is no approval required from shareholders for transactions between holding or wholly owned subsidiaries. So if there is a company holding company and the subsidiary is a wholly owned subsidiary, means 100% of equity share capital is owned by that holding company. In that case, the shareholders approval will not be required. Right. So this was the two-step approval mechanism under Section 188 of the Companies Act. Right. Now we spoke about Rule 15 of MVP. What are the limits that are actually prescribed, based on which we require the shareholders' approval. So Rule 15 of the Companies MVP rule are actually in short known as a materiality limit. So what does that rule say? That if the transactions that we actually saw in Section 188, so sale, purchase, or supply of any goods or materials, where the transaction value is 10% or more of the annual turnover of the company, only then a shareholder's approval is required. Category B, selling or otherwise, like we saw, disposing of or buying property of any kind, directly or through the appointment of an agent, if the transaction value is 10% or more of the net worth of the company. Leasing of any kind of property, so where the transaction value is 10% or more of the annual turnover of the company. Availing or rendering any services when the transaction value again is 10% or more. So earlier, I think there was more than 10%, but in one of the recent amendments a couple of years back, it also included equivalent to 10%. So if you see the wordings are 10% or more, it's not more than 10%. So appointment to any office or place of profit in the company, the monthly remuneration shall be exceeding to 250,000 rupees. So if the monthly remuneration to such a person, monthly, mark the word monthly, it's not an annual remuneration. If it crosses 250,000 to 250,000 rupees in a month, then that transaction would be requiring a shareholder approval. Underwriting the subscription of any securities. So the transaction value, so let's say when you're paying the underwriting fees or anything, is exceeding 1% of the net worth of the company. The turnover or net worth shall be computed from the audited financial statements of the preceding financial year, right? So because in the current year, if you are checking only the last year's financials would be audited and verified, right? So that's how you will calculate. So these were some of the limits which are covered in Rule 15 of the Companies MVP Rules 2014. Now, as I said that there were, 188, which talked about transactions, and then there was approvals, and then there is 177. Now, 188 spoke about shareholders and board of directors approval. 177 is speaking about audit committee approval. So, when we see about an audit committee section, so only very few kind of companies are required to have an audit committee. Listed companies, for example, are mandatory to have an audit committee. And then there are, of course, limits prescribed under Companies Act under the relevant section, which speak about an audit committee constitution. One of the very important things is that the audit committee must be having, as per the law, majority of the directors. So minimum 3 directors are required in the audit committee, if I'm not wrong. And out of that, majority or 2/3 of those directors have to be independent, right? So let's visualize the audit committee. Now we are actually speaking about very large companies, right, where it's required. So that's why the regulator says, the Companies Act says that all transactions as identified as related parties should be pre-approved by the audit committee. So there is no limit. There is no, like we saw in case of shareholders approval, all transactions have to be pre-approved by an audit committee. The auditor can actually see it from the audit committee minutes. The audit committee may make omnibus approval for related party transactions proposed to be entered into by the company. Now, what is omnibus approval? So omnibus approval actually means, consolidated or a standing approval given by a committee in respect of transactions which are repetitive in nature. So basically, because each time it becomes difficult for the committee also to give give approval for each and every different transaction. So what they do is that they give, and this is very prevalent in most of the companies. You will see this an omnibus approval. So at the start of the year, they give an approval for the entire year. That is called an omnibus approval. And this omnibus approval shall be valid only for a period of 1 financial year and shall require fresh approval after expiry. So in case that, one financial year is finished, so there is a new omnibus approval that is required to be made by the audit committee. Now, the audit committee shall, after obtaining approval from the board of directors, specify the criteria for making the omnibus approval. So basically, the audit committee will also specify actually the criteria for making omnibus approval, which means that what all will be mentioned there. So the maximum value per transaction you will see this kind of in the audit committee minutes. Maximum value of transactions in aggregate. So in total of the year, so let's say they say 5,000 crores of sales can be made to related parties, or 5,500 crores of purchases can be made from related party vendors. And then a per transaction value would also be defined. Then the audit committee will review at such intervals these, transaction limits as well. The omnibus approval shall contain or indicate the following name of the related party. It should not be vague. It should not say that, okay, we will be making 5,000 crores of sales with related parties. Which related party, what transactions, what kind of transactions, what is the nature and duration of the transaction. Everything has to be mentioned in this approval in detail. Only then when an auditor can pass that the compliance has been met. And if you see the word, it is saying shall, right? So it's not saying may, it's not saying could be, it's just saying shall contain. So this is a mandatory thing. It should contain the name of related parties, right? There is, however, one exclusion for this audit committee approval, and the exclusion is that, these provisions shall not apply to a transaction other than referred in 188. So all these provisions that we just spoke about, 177 or even 188, will apply to only those transactions that are mentioned in 188 between a holding company and its wholly owned subsidiary company. So if the transactions that are happening, any other transaction that happens, which is not mentioned in 188 between a holding company and a wholly owned subsidiary company, it's outside the ambit of audit committee approval. Now, we've seen some provisions with respect to Companies Act. Now, moving on to, let's talk about SEBI, the regulator of our markets. So SEBI listing order disclosure requirements 2015 has actually been one of the very main regulators who are actually very closely witnessing and closely analyzing these related parties and related party transaction laws. So SEBI very recently, so SEBI clause 23, like we spoke in the starting, is actually related to the requirements, the regulations that the listed companies are required to do in terms of related parties and related party transactions. But very recently, on November 9th, 2021, and some SEBI kept on issuing clarifications and widening and etc. After that as well, amended the provisions of those transactions to increase the ambit of related parties and related party transactions. So the provisions pertaining to related party and related party transactions to strengthen the monitoring of related party transactions and for better governance. So what were those changes? What was increased in the SEBI LODR regulation? So the definition of related party, right now we are only talking about related party, not related party transactions. So the definition of related party earlier was Section 276, like we covered in the beginning of the Companies Act or under the applicable accounting standards. That is still the same. But there was one proviso. The proviso was that any person or entity belonging to the promoter or promoter group of the listed entity and holding 20% or more of the shareholding shall be deemed to be related party. So there was a deemed related party clause which said that any person from the promoter or promoter group of the listed, if there is any person who is actually a promoter or from the promoter group of the listed entity, and he also holds 20% or more of the shareholding, then that person will be deemed to be related party. But now SEBI has widened it. And if you see, it has actually revised the laws and said that any person or entity belonging to the promoter or promoter group of the listed entity or holding 20% or more of the shareholding. So earlier it was an and clause that promoter group plus holding 20%. Now it's slash or holding 20% or more. And this 20% is also now, lowered to 10% or more with effect from 1st April 23, right? So it's key. So slowly and gradually, laws are actually, evolving to bring in more transparency, to bring, and widen the scope of related party compliances. So this was one change that happened. Now we spoke about the definition as per SEBI. Now we're speaking about definition of related party transaction, right? So if you see that existingly, a transfer of resources, services, or obligations between a listed entity and a related party, regardless of the price. Okay. So what was the current scope? That was that there was a transfer of resources, services, or obligations between a listed entity and a related party, right? Now just look at this, how it has widened. It says that a listed entity or any of its subsidiaries on one hand and a related party of the listed entity or any of the subsidiaries or the other hand. So basically, this is the same that a transfer of resources between, instead of only a listed party and related party, it has also brought in its subsidiaries. That a listed party or any of its subsidiaries on the one hand and related party or any of its subsidiaries on the other hand, all will be related parties, considered as related party transactions. So any transactions between all four of them will be related party transactions. Then a listed entity or any of its subsidiaries on one hand, the same thing, which the benefit of the related party or the listed entity, or the effect of those transactions is basically to benefit the related party of the listed entity, right? So if you see that the definitions are being widened, the scope is being widened, right? Now, as per SEBI, also there is, the requirement of approvals, right? Now, Regulation 23(2) speaks about the prior approval of audit committee. So what was the existing regulation, right? So existing law said that all related party transactions shall require to provide prior approval of the audit committee. Very nice, very fine. So this was the existing, that all related party transactions would require audit committee approval. Now, what is the revised? Just see the extent of, increasing. All related party transactions and for subsequent material modifications. So if those transactions are even modified, those will also require audit committee approval of the listed entity. And who is going to approve? Earlier, there was no clause of this. But who is going to approve from the audit committee? Only those who are independent directors. So even if, one person is, or two or three per person is, are not independent directors, they are not to be involved in the listed companies. Only the independent directors are going to approve from the audit committee, right? Now, RPT to which the subsidiary of a listed entity is a party, but the listed entity is not a party, shall require, prior approval of the audit committee of the listed entity. So now what they're saying is, earlier only it was talking about the listed entity. Now what they're saying is that if there is a related party transaction to which the subsidiary of a listed entity is a party, the listed and the main holding company is not a party, only the subsidiary of that listed entity is a party. Now, those transactions will also require audit committee approval of the listed entity if the transaction value exceeds 10% of the annual consolidated turnover. And after 1st April 23, this annual consolidated turnover has changed to annual standalone turnover. So just see because consolidated turnover is huge, right? But a standalone turnover is actually not that big. So just see the levels of, widening of the scope of related parties. Now, talking about increasing the ambit of, we're talking about increasing the ambit of related parties. So now we spoke about audit committee approvals. Now Regulation 23(4) actually, speaks about prior approval of the audit shareholders, of the shareholders, basically. So what was the existing law? So the existing, regulation spoke about, all material related party transactions and subsequent modifications shall require prior approval of the shareholders. Now, it is the same regulation right now as well, that all material related party transactions require prior approval of shareholders, but the definition of materiality has changed. So what is the material transaction as per Regulation 23(4)? Earlier, it said any transactions between related parties that exceeds 10% of the annual consolidated turnover of the company Now it has been revised to say a transaction with a related party is material if the transaction exceeds 1,000 crore or 10% of the annual consolidated turnover, whichever is lower. So earlier there was only one condition. So now let's say that if the the annual turnover of the company, let's say, is 20,000 crores, for example. So the 10% was 2,000 crores. But now earlier it was not it was not coming into the ambit of related party transactions. But if you see in isolation, it's a huge number, 2,000 crores, right? But now it has, because of the revised laws, it will be considered because the 1,000 crore limit will come into play, right? Some key points to note here, that the transactions, when I say that transactions, material transactions, or even before, if you see all related party transactions, wherever the transactions are mentioned, they are to be entered into, so they are to be taken individually or together with any previous transaction. So totality would be seen as limits, not a single transaction, right? Shareholders approval can be granted through a resolution, not necessarily a special resolution. Now there are some exclusions because these are very normal, very very usual corporate actions like payment of dividend, and I'm talking about listed entities, right? Everybody receives dividends, subdivision of consolidation of securities, or rights issue, bonus issues, buybacks. So these are very very normal, and these are called corporate actions in layman terms. So any kind of all these corporate actions are actually ambit of the shareholders approval, right? Now when we come to we've talked about Companies Act, we've spoken about SEBI regulations. Now, when we speak about IND AS 24, right, related party, so this is actually majorly a disclosure standard. It is not a compliance standard. It is a compliance standard from a disclosure standpoint, but it is not an accounting standard. It's not like giving you accounting of some transaction of related party. It's only a disclosure standard, but it also gives scoping definitions of what all is covered as related party and what all is covered as a related party definition. So when we talk about IND AS 24, so what it says that an individual will be considered as related to a reporting entity. So IND AS uses the word reporting entity because now you've come into the ambit of accounting and you come into the ambit of reporting and auditing, right? So an individual is related to a reporting entity if, right, the individual or any close family member of that individual has a joint control or a control over the entity, has significant influence over the reporting entity, or who is a member of the key managerial person of the reporting entity or of the parent of the reporting entity. So basically, it's saying is that one individual would be considered a related party if there are three conditions. So that individual or a close family of that individual has either a joint control or a control, or has a significant influence over the entity, or is a part of the KMP group of that reporting entity, or even of the parent of that reporting entity, right? So in these cases, an individual will be considered a reporting entity. Now, what does a close family member mean? Again, the close family member includes children, spouse, brother, sister, father, your parents, your siblings, etc. But there is one thing that you must not have noticed now anywhere, be it Companies Act, be it SEBI, which is domestic partner. So this is actually in line with the international standards as well, which talk about domestic partners. And so US says that domestic. How do they define this? Is that when an exchange of rings happen. So I have not come across the definition of this right now, but it can be construed. But this is something that they've included as well. So close family members of a family includes children, spouse, domestic partner now, and children of that person's spouse or children of that person and the domestic partner as well is also included as a close family member. Now, what is a significant influence, right? So significant influence is the power to participate in the financial and operating policies of an entity, right? Now, when I talk about operating policy or the powers to participate in a financial and operating policy, so here also there is no limit. There is nothing which can be defined as a significant influence. So for some key examples that I have come across on, few of my engagements is like, a participation in planning, for example, of that entity, participate in the entire budgeting of that entity, or if somebody has the, the influence of, let's say that participating in the expansion plan of that entity, of giving, so that person actually has a significant influence and will be a related party to this. So for example, Mr. D is a director of H Limited. So H Limited, Mr. D is a director of H Limited. S Limited is a subsidiary of S Limited, and Mr. D is related to S Limited also, because the holding is making operating decisions and Mr. D is indirectly participating. So basically, H is the holding company, S is a subsidiary company, and because H is making an operating decision in the subsidiary company and Mr. D has a significant influence over H, so D is also a related party for S as well. So that is how the scope actually goes on. Now, when I talk about, so we spoke about right now a person, how a person is actually related to an entity. Now we are talking about what kind of entities are actually considered a related party, to the reporting entity that we are actually talking. So if one entity is a joint venture of a third entity, and the other entity is an associate of a third entity. So let's say that so imagine if there is one entity in the middle, one entity is a joint venture with that middle entity, and the third entity is actually is an associate of that middle entity. So both the joint venture entity and the associate entity will also be related parties. So JH Limited is a joint venture of H Limited. AH Limited is an associate of H Limited, then JH and AH are actually related entities. So this is covered here. Both entities that we're talking about are joint ventures of the same third party, right? So for example, if there are two entities and they are both entities actually are joint ventures of the same third party, then both these entities are actually related. So for example, H Limited has entered into two JVs, right? So one JHA Limited with A, right? And one JHB Limited with B. So JHA and JHB are also related parties. One entity is an associate or joint venture. This is very easy that if you are, and if one entity is your associate or a joint venture, then of course they will definitely be your related parties. But if they are an associate or joint venture of some other entity in the group in which you are also a member. So when I said a group in the starting, it meant that a group of JVs, associates, subsidiaries, and holdings. So if you see that that's a group, so any party who being any associate or JV of any party in that group is related to each other. So for example, C Limited is an associate of S Limited. S Limited is a subsidiary of P Limited, right? So if you visualize, so C Limited is so S Limited, P Limited is the main entity. S Limited is a subsidiary of P Limited, right? And C Limited is an associate of S Limited. And Z Limited, another subsidiary of P Limited. So C Limited and Z Limited are actually related parties because this is one group. The entity and the reporting entity are members of the same group, right? So basically the entity and the reporting entity are members of the same group, which means that each parent subsidiary and fellow subsidiary is actually related to each other. So SA Limited and SB Limited are subsidiaries of H Limited. Then SA Limited and SB Limited and H Limited are all related to each other. Now, when I talk about joint venture, what exactly is a joint venture? Joint venture is an arrangement whereby two or more parties have a joint control over the joint arrangement, right? So there is one arrangement, one common joint arrangement which both the parties sign. So when two or more parties have a joint control over that arrangement, then it's considered a joint venture. And an associate is an entity in which the investor has a significant influence with 20% or more voting rights, right? So that will actually be considered as an associate. So that's how the definition as per India's 124 flows. Now we've seen the definitions, we've seen the approval processes, we've seen some of the keynotes, etc. Now I want to take you all to what are the disclosure requirements, right? So when we talk about disclosure requirements, related party relationships and transactions, what disclosure are actually required for these? So when we talk about Companies Act, right? Companies Act 188(2), and there still may be many disclosure requirements that I have not included here, because it's not possible. The law is so wide, the regulations are so stringent that it's not possible to cover everything in one presentation. So the Companies Act itself has so many sections like 185, 186, etc., which also indirectly talk about related party transactions. So when I talk about Companies Act 188(2) says board report. So every contract or arrangement entered into by the company shall be referred to in the board's report to the shareholders along with justification. So this is the key point that I want to highlight, that along with the justification, they have to, show in the board's report. Caro, let's talk about Caro 2020, right? Even the previous Caro, Alliance Shekharji also mentioned Caro when he was giving a keynote. So what regulations or what disclosure requirements are there, in the Caro 2020? So paragraph or clause 3(3)(f) says that the aggregate amount or the percentage of the total loans granted or the aggregate amount of loans granted to promoters or related parties should be disclosed. The paragraph 3(3)(a) and capital A says the aggregate amount during the year and the balance outstanding at the balance sheet date with respect to loans and advances and guarantees and securities to subsidiaries, joint ventures, and associates should be reported in Caro. Paragraph or clause 3(4) says that in respect of loans, investment, guarantees, securities, where the provisions of, like I said, 185 and 186 have been complied with. So 185 basically means that, if I remember, I think it's loan to directors, and 186 means that, loans and investments made by a company to related parties. So both these sections also speak about certain laws, certain compliances that are to be made with respect to loans and investments, right? So that also has to be disclosed under Caro. Paragraph 313 is, is a very common paragraph. It says that whether all transactions with the related parties are in compliance with section 177 and 178 that we saw on the top briefly, where applicable, and the details have been disclosed in the financial statements as required by the applicable accounting standard. Now, I want to mention one thing. So as an auditor, when we are, we are required to actually, we should ideally document each and every working of ours, each and every finding of ours, each and every reporting of ours, to keep it actually as a, as a repository, as a, safeguard against any regulators wanting to, see what kind of work we've done. So a Caro work paper is also generally made. A Caro work paper is also made when we talk about Caro disclosures. So how will you test this, that whether the company has 177, 188, you obtain all the minutes, you obtain all the board minutes, you list down the transaction and see whether all the transactions are within the omnibus approval or whether the transactions have been approved by the board or not, right? So why I brought this point is because it is very important for me to say that, there should be documentation around all these things. Only just, seeing on, on the top of our, work that, okay, this is compliant does not suffice. What the work not documented for an auditor is work not done. So make a proper work paper for Caro for each and every clause, each and everything, attach all the documents, all the minutes, etc. And that's how you proceed with it. When I talk about SEBI disclosures, right? So SEBI Regulation 23 also says that filing to stock exchanges is necessary. So earlier, I think it was something 30 days or some limit was there, but now, it has actually been reduced. So the regulator is not giving any time after the date of publication. So the regulator is saying that the listed entity shall submit to the stock exchanges, NSE, BSE, disclosures of related party transactions in the format specified by the board. We are not getting into the format. The listed entity shall make such disclosure every 6 months on the date of publication of its standalone or consolidated financial results with effect from 1st April 23. So earlier, I think it was some 30 days or some, if I'm not wrong. But now the date on which the listed entity is required to publish its standalone and consolidated results every 6 months, that is the date when the entity will have to file the related party transaction disclosures as per SEBI. Now, some examples that I have brought for everyone, when we spoke about board report, disclosure. So if you see, this is one listed entity, Gravita India Limited. I've taken this extract from FY22 annual report. So that's how they are presenting the related party transactions, that all related party transactions were on arm's length price and etc. Arrangement transactions with related parties, which could be considered material. Details with respect to transactions with related parties entering the company are in Annexure 1. All the KMPs have been included, promoters, directors, or other designated persons which may have a potential conflict. So why I brought this screenshot is basically to actually show you that the compliance, how it is actually being fulfilled by the companies, right? Wipro Limited, so the Caro clauses that we spoke about, so they are in the latest March 23 financial year closing, Caro 2020, they've reported the loans aggregating to, these many millions fell during certain subsidiaries, loans aggregated to this has been renewed, extended. So all and every details are required. There were no fresh loans, then, these are the related parties and what is the aggregate amount of overdues. What is the percentage? Like I just showed you that here. I think we were talking about the percentage thereof, right? So what is the percentage of total loans granted during the year, right? And the company, and then there is this another clause which says the company has not provided any loans in contravention of these clauses, and then the 177, 188, that in our opinion the company is in compliance with 177 and 188. So this is based actually on a very solid work paper that the auditor actually makes, right? Now, when we talk about Ind AS disclosures, right? So we've spoken about Companies Act, some disclosures, we've spoken about Caro disclosures. Now, what does Ind AS say? So Ind AS say that, the objective of the standard is to ensure that the financial statements contain the disclosures necessary to draw the attention of the users, right? So what are actually the important disclosures as per Ind AS 24? Again, the list is huge. The list is long, but I've only included the key disclosure that you will see across entities. So the relationship between a parent and a subsidiary shall be included, irrespective of whether there has been any transactions or not. So right now here, we are talking about relationship. We're not talking about any transaction. Should be disclosed between a parent and its subsidiary, irrespective of whether there has been any transactions or not, right? Then the entity shall disclose the name of its parent or the ultimate parent and disclosure of interest in other entities like JVs, associates, etc. In case there is any related party transaction during the periods, that are being covered by the financial statements, disclosure of information about the transaction and outstanding balances as well. Not just the transactions, not just sale and purchase, even AR, AP balances, etc. are required for an understanding of the potential effect of the relationship. And these should include, these transactions and balances should also, include nature of the related party transaction. What is the nature of that transaction? What is the amount of that transaction? What are the amount of outstanding balances for doubtful debts, etc. KMP compensation. Now, this is something where people tend to miss that whether it's included or not. KMP compensation in total for each of the category of KMPs, right? Now, whatever I have said here actually has to be disclosed for parent, subsidiary, associate. So all these disclosures will be categorized under these specific categories. So parent, subsidiary, JVs, then entities having joint control or a significant influence over the reporting entity, any transaction with those, then KMPs, any LLP firm, any enterprise over which this KMP exercise significant influence. So these transactions, these disclosures will be made for each of these categories. Now, when I talk about compensation, right? So what does compensation include? So compensation includes all employee benefits, not just salaries and wages. It includes short-term employee benefits, includes post-employment benefits. It includes other long-term employer benefits, termination benefits, etc. So when I talk about short-term benefits, it simply means salaries, wages, or it could also be, I think, any overtime amount. So short-term basically means which are to be paid in the next 12 months, right? So any kind of those employment benefits paid to KMPs, any post employment benefits like pensions, like gratuities, etc. Any other long-term employer benefits, any termination benefits. So termination benefits can be, so let's say leave encashment. So that is something that a person encashes at the time of termination, or a severance pay. So, and any ESOPs or any kind of those kind of payments. So all these, compensations would be covered under the ambit of KMP compensation, right? Now, some examples, like we just spoke, right? Some examples of these related parties. So if you see, this is again an extract from the Gravita India Limited annual report. This is a disclosure related party under Ind AS 24, right? So like we spoke, name of the related party and the nature of related party needs to be disclosed. So subsidiaries, these are the subsidiaries, these are the associates, these are the partnership firms. What is the nature? LLP is the nature. These are the LLPs with the company, the country of incorporation, the percentage of holdings, whether it's wholly owned. So this is an associate, so that's why it has 25% of the holding. Then, partnership firms, what is the profit percentage here, etc. Then enterprises over which KMP or their relatives exercise significant influence. Like we saw here, right? Enterprises over which KMP exercise significant influence or their relatives as well needs to be captured. So this is one category. So these are the entity names. What are the key managerial persons of the entity and what is their designation, right? So company secretary, independent directors, CFOs, whole-time directors, CEOs, everything and anything needs to be disclosed. Even the relatives of these KMPs needs to be disclosed with whom transactions are taking place. So the relatives of KMP only have to be disclosed in case any transactions have been, taken place with them. Then, of course, these are normal transactions with related parties. So sales are there, for example, subsidiaries. So the amount of sales, the parties with which the sales have been made. Then, as a example, dividend paid to KMPs also needs to be disclosed. The amount of dividend paid, like we spoke about remuneration, I was just telling in the previous slide, remuneration paid to KMP needs to be disclosed. Short-term benefits, post-employment benefits, everything like we spoke, which is mentioned, actually companies are disclosing all these things. And then normal transactions with some of KMPs as well. So purchases of property, plant, and equipment, if from any KMP needs to be disclosed, partnership firm, etc. So I've just got this example to give you a practical view of how actually listed companies are actually reporting their numbers. Now we move on to, we've covered compliances, we've covered disclosures related to related party. Now let's move on to audit of related parties, right? So when I speak about audit of related parties, SF 550 is the standard which actually has to be followed. But what I have done is I've tried to actually bifurcate the audit, and I've kept it a little on a practical side, bifurcate the audit on a basis of 5-step models like planning, risk assessment, and all those are the 5 phases of the audit that is there, right? So when I talk about planning, what is the objective of the planning phase? It is actually in terms of only related party. The objective is to identification of the related party transaction with known related parties and identification of unknown related parties. So in the planning phase, generally, as an auditor, we are actually planning our related party procedures. We are actually, focusing on how we should plan the audit for the current year with respect to this area of the financial statement. So what all can you do in the planning stage? So you can obtain an understanding of the related party transaction. The first and the foremost is obtain an understanding. And when I say understanding, it means understanding of your own laws and compliances, as well as understanding of your own laws and compliances, as well as understanding of the entities, related party relationships and transactions. review of the last year's file. So what you should do as a procedure is you should definitely go back to your last year's closed engagement file and see the previous knowledge about the client industry, in which industry is your client, what could be the potential kind of related parties, and what are already identified as related parties from last year. So both of those, the list should be there with an auditor. Then the auditor should ask management about the identity of the related parties, including any changes if they are known, the nature of the relationships, etc. So as an auditor, go up to the management, talk to them, have inquiries with them, understand whether they know exactly what related parties are, what it's not, and any identification that they know are as related parties. So you should have all those as a part of your planning, document them, any changes from the prior period, any known related party relationships, any discussion with the clients. It is important to explain who or what related parties are and their importance. So a lot of clients, specifically, smaller companies who do not have, a lot of company secretaries, chartered accountants, and a team of, handling compliances, etc. They actually till date don't know exactly what is the law, what exactly is the ambit of related party transactions. So when you are actually speaking to the client, no, I have never seen people do it, but always, when you are speaking to the client, understand their level of understanding. If they do not explain it to them, there may be a situation that basis on their understanding, they have considered something which is not a related party, but actually as per the compliance or as per the ambit of various laws, that party is a related party, and it is baseless and based on pure, innocent ignorance. It could be. Segregate your questions. Now, when you are actually, asking questions to the client people, I would suggest segregate your questions. More sensitive questions could be addressed, of course, can be, reserved for the senior management. But then definitely as an auditor, you have the right and you should exercise it to ask some general questions as well to the normal finance and account staff, even asking a question. So I'll tell you one example. When I was auditing one of the clients, when I spoke to the finance controller of that client, right? So finance controller was not actually aware of these laws and etc. And he could not answer properly. But when my team sat with the person who was actually booking revenue entries in the software, in the ERP, that person told them, about the names of a couple of entities and a couple of clients, a couple of entities with which the company was transacting and which actually came into the ambit of related parties. So it is very important not to just restrict your questions to, only the senior management. You should also actually, just for the sake of knowing, you never know, somebody or the other might know, right? So just for the sake of knowing, you should actually ask some queries to other people as well. Now, moving on to the risk assessment phase. So what does the phase risk assessment actually mean? The phase risk assessment means actually setting a risk of material misstatement for a related party transaction or the related party area, which means, a combination of having a control risk, a combination of having an inherent risk, and then setting your final risk of material misstatement. It could also be a risk which is prevailing at the entity level. It can be an entity level risk as well. So we have to be very careful while we are dealing with this audit stage of risk assessment. Some of the key things that an auditor can do is actually, significant transactions. The first and the foremost is that, all significant transactions that you've, come across, or the name of the parties or the name of the related parties from the previous year, you should actually share it with the engagement team. A lot of, seniors, managers, directors and all, they say that, these are very confidential information. Nothing is confidential in this. You have to share it with the lowest member of your engagement team that, boss, these 5 parties are related parties. Keep an eye open when you are doing your area. He may be doing a cash and bank. He can be dealing with the related party bank. You never know. So always, flow these information to the lowest part of your engagement team. Consider the susceptibility of the financial statements to material misstatements due to fraud or error. Consider the susceptibility of the financial statements to material misstatements due to fraud or error that could result from the entities, related party relationships, and transactions. So we have to consider the susceptibility, how susceptible the financial statements to material misstatements are actually that could result from related party relationships. So like we were speaking in the beginning, the extent of related party transactions can be really wide in an entity. 80% of the transactions can be related party. So if that is the case, then the susceptibility of the financial statements or the susceptibility of the manipulation increases, right? If only 2 or 3% of the transactions of a company is with related parties, I don't think anybody would, suscept any kind of fraudulent activity. The next thing while you should do when setting an RMM is obtain understanding of the controls. Now, this is very important from a control risk perspective. So when you talk to the, hold inquiries of the management and etc., that is more towards setting the inherent risk, that how the entity's environment is, what kind of inherent risk is actually. But you should also understand the controls from the management, that what controls are in place to actually identify, account, disclose, authorize, approve those significant transactions. Because, if your control risk is high, then of course there is a high risk of material misstatement. So while doing and taking an understanding of controls, you should consider other sources as well as bank confirmations, legal confirmations, any kind of mentioning maybe there in any kind of third party confirmations, or even board minutes, shareholder minutes. Some maybe when you took the last year audit file, there were only 5 parties, but this year in the board minutes, let's say the board has given an approval for the 6th party, but it has not been disclosed to you, so you can actually take it from the board minutes. And this is very important application of professional skepticism all throughout. So even when you are doing a procedure as easy as vouching of sales, you should always keep your professional skepticism open. So when I was an article, or when I was, an executive, doing vouching and etc., what I had been told was that scrutinize the sales register. There may be a situation where and I have actually found, trust me, I have actually found a related party like this when on scrutinizing a sales register by just seeing the name. So let's say that the reporting entity name is XYZA Limited, for example. When you scrutinize the customers in your sales register, you may come across a party called as just having some other name, but the Y or Z is included in that name, but that has not been disclosed. So that is a part of your professional skepticism. You should single that out, ask the management whether this is a related party or not. So keep your ears and eyes always open when you are doing these kind of procedures. Now, there is another kind of risk of fraud, right? We spoke inherent risk, control risk, and there's also fraud risk, right? So what does SA 550 says relating to fraud risk? So, it says that an auditor should consider that there is a fraud risk if if they may come across certain fraud risk factors that are prevalent. Now, what are those fraud risk factors? Consider special purpose entities that are controlled by the management. If you remember in the first slide when we were talking about the frauds that happened, Enron scandal, the SPEs were created and were controlled by the executives of the company. So in case you come across any special purpose entities, inquire about those entities. What is the purpose of that entity? Why has they been created? Why is it being controlled by the management? If you come across transactions on abnormal terms, such as any unusual prices, interest rates, guarantees, or even repayment terms can be unusual. You may give a loan to one of your related parties and the repayment terms can be, let's say, 30 years. So all these actually, should come into the ambit of fraud risk, and you should, actually test and actually verify and assess whether there is a fraud risk or not. High volumes of significant transactions can be there. Significant transactions with a related party which is not audited. So a very common example is this, generally a lot of listed entities, a lot of big companies, they may be entering into transactions with related parties who are not audited. So because their balance sheets are not audited, their financials are not audited, half the risk of the fraud coming out is over. right? So this is a very common trade parlance. Significant or unusual transactions around the year end. If you see any unusual transactions around the year end, you should actually assess for any kind of fraud risk. And then if the entity has any significant bank accounts or has opened any branch or subsidiary operations in jurisdictions without a clear business rationale, right? So there is no reason for the entity to do it, but they have opened, any bank accounts or etc. there. So that should also be a consideration of a fraud risk. Now, when I talk about internal controls to identify control risk, so we spoke about, fraud risk factors. We spoke about risk of material misstatement. So the objective is now the assessment of internal controls to identify control risk. So when you are actually doing a control, when you're actually speaking to the management, when you're seeing a control assessment, whether the control environment is in place or not, right? So a couple of things that you can actually see for that. One is that whether the authorization and approval mechanism is there in place or not. Whether any policies or procedures for disclosure of interest is there in the company or not. So let's say that directors' interests have to be disclosed. So what is the policy? What is the procedure of a company that whether these things will come to light of the management and those charged with governance, most importantly. Then the assignment of responsibilities at the company for identifying, recording, is there a segregation of duty? What are the responsibilities here and there? What people have different responsibilities in terms of identifying somebody, recording, summarizing, or disclosing related party transactions. And then where controls over related party transactions and relationships are deficient, if the control environment is not there or non-existent, auditors may be unable to obtain sufficient appropriate audit evidence because those documentations are not there. The control is not there, so their audit trails are not there. Those authorizations you will not be able to get. Those approvals you will not be able to get. So you should consider the implications on those audit reports as well. Right. Now, once you've done your planning, you've done your risk assessment, you've seen the control environment, you've set the risk of material misstatement. Now you should move on to responses to the assessed risk, right? Now, when I talk about responses, majorly we talk about substantive procedures or substantive analytical procedures. What could be the audit procedures there? So when a management represents that RPTs are at an arm's length price, you should not believe them. You should go and test them. Like I mentioned, in your work papers, your revenue work paper should have a tab where you should test arm's length price. So what you should do is, you should put the product or the services that is provided to the RPT and actually compare the prices with the third party and the party. And then if there is any variance, you should actually inquire about the variance. So there may be a reason that the location is different. So obviously, if from Delhi I'm sending a product to Gurgaon, or from Delhi if I'm sending a product to Kashmir, there will be a difference in related party transactions, the price of the related party transaction at which it has been made, right? So that is there. The confirming terms and conditions with vendors, customers, lenders as well. So your related and unrelated, vendors or customers can be there with different terms and conditions. So confirm them. So let's say the entity will say that, okay, my credit period with an unrelated entity is 30 days. My credit period with a related party is also 30 days. What's the harm in confirming? Send out in confirmation. We send out debtor confirmation. Send out a customer confirmation. What is the issue? That customer may not be a debtor. The customer may be a normal, sales. So just send out any confirmation with which for any information that you need to be confirmed. Review the nature and extent of related party transactions that are in accordance with the applicable accounting standards. So, your consolidation comes into play, your business combinations come into play, your Ind AS 24 comes into play, your Companies Act comes into play. So any kind of reporting framework, compliance framework, you should, Caro work paper, like I mentioned, you should make and, work on those compliances as an auditor. Review relevant documentation to determine whether any previously unidentified related party occur. So there may be unusual sales, like I mentioned, in the sales register, any period end invoices, any correspondence from lawyers, asset sale purchases, contracts, agreements, board minutes, shareholder minutes, audit committee minutes, any kind of such documents should be reviewed. examine the purpose documentation and authorization for material transaction with component entities. So, so let's say that if there are 5 components of a holding company, then what are the purpose, what is the authorization with the transaction, and whether everything is in place or not. If any previously undisclosed unrelated party comes to light, promptly communicate the information to team members. So like I'm again and again stressing of the fact that all your audit team should be aware of the related parties, be it disclosed, undisclosed, current, previous, whatever. Everyone should know what are the related parties that are there with the entity. Now, some examples, of actually, so as an auditor, we're also supposed to, give suggestions to the TCWG or management on the basis of control environment, or what all controls can be in place to, appropriately address the situation of any kind of risk that the related party area is containing. So some examples of the control environment which can be recommended to the management is, assessing related party relationships and transactions as a part of company's annual risk assessment process. So if a company has an annual risk assessment process, include the assessment of related party relationships and transactions. Requiring board members to disclose all interests, affiliations, and transactions in a DNO questionnaire. So a director and officer questionnaire is there generally in an organization. So make it mandatory for all the board members to disclose, which is periodically reviewed by the legal and the finance department. Compile a RPT listing, which is reviewed on quarterly basis. The listing can be derived from various sources, including investment statements, accounts, etc. So there should be a team actually in the organization only working on compiling of the RPT listing. Provide training, clarification to management and key employees. So like I mentioned earlier that there are, there may be situations where actually, the management itself or the key managerial persons or the people who are actually preparing the financial statements, preparing the disclosures, they themselves are not actually, aware of what the, related party are. So the company should have a training procedure in place which should talk about to all these people, to all these key people who are related with this area, that what are the key employees, what are the related parties, what are related party transactions. So there should be a training mechanism for the client people. Then incorporating certain detective controls as a part of your ERPs only. So there are many large companies that are actually now, what they've started doing is that as a part of their own ERP system, they have brought in those checks. So certain detective controls they bring in as a vendor. So whenever a new vendor or a customer is entered into the system, so the check or that software or that whatever you may call it identifies if it's a related party or not based on certain parameters that are set in. So these are some of the internal controls that can actually be advised. Now, when we talk about documentation, right? You've done all your audit. Now, like I was again and again stressing documentation. So why is it important? It is helpful when subsequent audits are doing, when any regulator is behind your back to, actually substantiate that the audit procedures you've done or your firm has done is fine, is complete and accurate. So you need documentation. So what are the bare minimum things that should there be in your documentation, except for your, of course, work paper related, area related substantive procedure documentation is the names of the identified related parties and the nature should be there. The assessment of risk of related parties must be there, which was carried out at the planning stage. At the planning stage and the risk assessment stage when we did, that should definitely be there. The assessment of risk that was there. And also what discussions happened among the engagement team. So there may be some discussions that happened among the engagement team based on which some plan was set up. That discussion should also be documented. The understanding of controls, what controls that you understand, and significant risks, the risk assessment procedure, the risk of material misstatement that we have identified at the financial statement, like at the entity level, at the financial statement level, and also at the assertion level. Then any changes identified during the audit, right? So this is the bare minimum that as an auditor should actually document. Now, when we talk about completion stage, which comes after the documentation stage is that what should you communicate to management and TCWG? So if you see that, as an audit engagement, after or towards the end of the audit, it is extremely important and mandatorily to take a written representation of the management. This is again to actually, safeguard the auditor again against anything that the management has hidden, right? So written representations from management that they have disclosed the identity of the related party. So in your MRL, it's also called a management representation letter. It should be included that they have disclosed all the related party that have been there, all relationships they've disclosed to us, all transactions of which they are aware have been disclosed to us. The auditor may wish to obtain written representations directly from the TCWG as well, right? So basically, not just from the management, you can actually put a signatory, a TCWG as a signatory. So just not from the management, not from the CEO, CFO. You can also actually put a board of directors in, in the signature to your written representation. Then communication to management and where different TCWG, where both are separate, you can actually also provide TCWG these written representations. Significant matters relating to related parties that you have come across your audit. So if you see that there is a audit committee presentation in large companies that is made. In smaller companies, there is it's called, I think, the terms can be different, but it's called audit rep letter, or it's called result communication to TCWG. There may not be an audit committee. It's just a result communication. So in that, you have to include significant matters relating to related parties, any undisclosed related parties or related party transactions that came to light, or any disagreements with the management that you came across over, inquiries, etc., over the disclosure. So you may, as an auditor, may be saying that this X transaction or this X nature should be disclosed, but the management is saying no, it does not, or the law is silent on something where there is a disagreement. So those kind of situations also should be provided to TCWG. Then auditor should ensure that the related party disclosures are appropriately included in the financial statement. So that is also something which is actually the job of the auditors only, that you should, when you are actually auditing the financial statement, you have to ensure that the disclosures are also properly, that the entity has disclosed all related party disclosures as required as per different standards. So, I think, thank you so much, for patiently hearing to all the views and the presentation that I had. So, we went across the definition, then we went across, the compliance part, then we went across the procedures, then we went across, the disclosures, then the audit. So hopefully I've tried to do as much justice as I could to this, this topic. Thank you so much, everyone. Yeah. Anilji? So any questions? I think where अनिल जी आप हैं क्या वहाँ पे?
Sir,
हेलो
sir, can you hear me?
हाँ जी अनिल जी आपकी आवाज आ रही है.
Can you hear me?
Yes, I can, but very low volume.
There is some technical issue, sir. Now can you hear me?
Better, it's better. Yes.
Sir, you are there?
Yes, I'm there. Can you hear me,
Sir,
Anil
you are
ji?
there?
Yes, I'm there.
No, sir. Sir, first question is whether such disclosure is.
Anil ji, your voice is gone.
Sir, whether such smaller companies, sir, whether
Anilji, you are not clear at all.
sir, whether such disclosure is necessary in case of smaller company.
Yes, so there is no distinction between a small or a big company. Like I mentioned that, the limits are there on the basis of the transaction limit. So in case of 188, if you see, board approval will absolutely be required for smaller companies as well. The shareholder approval may not, because the smaller company may not be making those kind of transactions, right? So there is no, but the audit committee approvals definitely will not be applicable to smaller companies, because the audit committee itself is required only for large companies, right? So there is no distinction between RPT disclosures and approvals, etc., for smaller companies. So that is definitely applicable.
Sir, one more question, sir. This is sir, when one need to report the value of the RPT, do we need to disclose only the base amount or including the GST amount charge and excluding adding the TDS or TDS?
Right. So basically, your GST, TDS, and TCS anyway is not a part of the revenue, right? It's not a part of the sales. So you have to only disclose the base amount.
Yes, sir. Sir, another question is, please, can you put light on the issues when the RPTs are lower than the ALP in favor of the company?
RPT
are at a lower than the ALP, that is in favor of the company.
I didn't get the question, Anilji. Can you repeat once?
Sir, please let me know the issues when the RPTs are at lower than the ALP in favor of the company.
RPT is lower at the KMP?
Yes, RPTs are lower than the ALP.
ALP, okay. So what issue comes if the related party transactions are lower than arm's length price, right? So the issue might come. So let's say that, if you want to pay low tax, for example, let's assume a situation. Now you want to decrease your revenue. Now the earnings that you have with a third party cannot be manipulated, because the confirmations will be there, everything, all your audit procedures will be there, everything will be there. What can you manipulate is a related party transaction, right? So let's say that you are selling a laptop to a third party, as well as you are selling a laptop to your related party transactions. Now, the third party, the same laptop, the same model can be sold for, let's say, 40,000 rupees per piece, but to a related party, you're selling at a 25,000. So you are actually lowering your sales, right, to avoid taxation. So these are some of the issues. So, there is no fixed, let's say, framework, or there are no fixed issues that, okay, these 4 issues, 5 issues, all transactions have to be looked, presumed, and, seen from the lens of a suspicion. You have to actually inquire about all transactions as an auditor. Why was it done? What was why was it done? Prove me. You can go up to the management and say, prove me that this transaction is at arm's length price. So, they can provide you they can provide you a domestic transfer pricing certificate. Maybe the domestic transfer pricing is, applicable to the client. They can provide you that certificate, which clearly writes that, okay, this transaction made to this party is actually at arm's length. So you can ask for any evidence. That's the key to it.
Yes, sir. So another question is, in a large company with several subsidiaries, how best can we prepare a complete RP schedule? What is good method to aggregate all required information without omissions and get it right very first time? What about the forest transaction amount embedded with the branch balances?
So I didn't hear the last part, Anilji, but the first part I'll answer is that how can you make a very large disclosure for, one holding and so many subsidiaries? So, there is no shortcut to it. The only thing I will say is that, you have to see that the controls are in place. If the controls are not in place, then it is actually an auditor's headache. because you cannot report, you cannot sign on something which is incomplete. So the preparation actually has to be done. The primary responsibility for creating a financial statement is always management's. It's not auditor's responsibility. But to verify, it's auditor's responsibility. So if there is a holding company which, let's say, 16 subsidiaries, how do you prepare one disclosure? You have to prepare. So there is, by gathering of information, the teams have to be large, or a couple of people. Let's say you can allocate 4 or 5 people only working on the related party disclosure area, right? Let's say for 5 days or 10 days. So there are ways and means of doing it, but you have to do it. There is no shortcut. You cannot aggregate all the transactions. You have to disclose all relationships individually. So if there are 17 subsidiaries, you have to disclose 17 different subsidiaries. You cannot aggregate those transactions.
Yes, sir. Yes, sir. Tarun sir, you are there? Tarun sir? Chairman sir?
नहीं है
Okay.
तरुण सर अभी ज्वाइन करें
Tarun sir, you are there? Tarun sir, you are not audible. आप अनम्यूट कर दो. Tarun sir, you are on mute. Chairman sir?
Hello.
Chairman sir, you are there?
Hello.
हाँ जी sir. Sir, please raise question sir.
मेरा कोई क्वेश्चन तो नहीं है.
So WhatsApp
Hello.
है ना?
Hello.
Sir, you are there?
Hello.
Tarun sir, you are there?
हाँ जी. Wait.
Sir, third question is, a director of a private limited company, say a stockbroking company, enters into transactions with
A director of a private
limited company,
yes,
say a stockbroking company enters into transaction with the company for which no brokerage is collected. That transactions runs into crores of rupees. Is there any disclosure requirement?
So if I talk, so what I gathered, Anilji, was that there is a director of a private limited company, and the company is paying brokerage to stock brokerage, or the director is paying. So if the company is paying to the stockbroker, then there is no related party relation. So you have to actually see, you have to see the kind of, so if a director is paying on behalf of the company, does not mean it is a related party transaction, right? The related party has to be first identified. So the related party is director. The related party is not the stock brokerage firm, right? If the related party was the stock brokerage firm, then this would come under the ambit of related party transactions. Hello? Anilji, any more questions?
Yes, sir. Sir, next question is guarantee given by the holding company to a bank for loans taken by the subsidiary, a RPD for its subsidiary?
Yes, it is a related party transaction. So like I mentioned in the slides, related party transactions are not just prices, even guarantees, securities, etc., given on behalf of your related party. So subsidiary is a related party of a holding company. If you are giving a guarantee to any third party on behalf of your related party, is a transaction with the related party.
Okay, sir. As a person who is in live-in relationship with a director, ENP, are covered under the related party.
So, India says this, that a domestic partner, so, there is still not a clarity as to what stage. Will it be after ring exchanging? Will it be after, engagement fixing, etc.? But yes, one can argue that it can come under the ambit because it only says domestic partner. So domestic partner can be defined as somebody living with you also.
Yes.
Right. We'll have to carefully look this, up in case of any case laws that have been there previously, in case of any any court judgments that are there in terms of what is a domestic partner, etc. Because generally it refers to an individual or relationship which is close to marriage.
Yes. Sir, dividend paid to related party companies in which director are shareholders is to be disclosed.
Yes, absolutely.
And how to calculate the arm's length price? How to calculate arm's length price?
So, there are many formulas, that we can gain help from, like you have income tax provisions, where there are so many methods, like, RSP method. And, I'm not an expert in income tax, but, there were, cost method, or, there were some methods that were there mentioned under the transfer pricing laws. So you can use those. You can actually, resale price, cost plus, etc. There are many methods there, but there is no fixed thing that you cannot, as an auditor, you cannot use this XYZ thing for your workings. You can use those for your workings. You can use any help you want to, any formula you might have, any working you might have come across from anybody else as well. You can include that. The idea, the intent is to justify that the price at which any goods or services has been given to a related party
is
a usual price.
Sir, reimbursement of the expenses paid to directors, should these transactions be reported as related party?
Come again, Anilji?
Reimbursement of expenses paid to director, should these transactions be reported as related party?
Yes, these transactions are also to be reported to related party, because these are also related party transactions.
Sir, last question. One company was using MBP4 form to identify related parties. Is this correct?
So it is correct. It is not the complete procedure. So using MBP4 for identifying related parties should be one of your audit procedures, as well as companies procedures as well, to identify related parties, but it's not all audit procedures. So you have to do additional things as well, not just relying on MBP4. You have to do your scrutinies, you have to do your inquiries, you have to do your risk assessments, you have to do your controls, you have to see other minutes, you have to see shareholders minutes, board minutes, this, that, etc. Right?
Yes.
Because a company who can hide, let's assume a company who's intentionally doing a fraud, they will not disclose it in MBP4 as well, right? They will not include it anywhere.
Thank you, sir. Thank you so much for sparing your valuable time. It was wonderful deliberation. You have covered all the aspects relating to the audit disclosure and compliance. And due to the technical glitch at the end, there was some confusion as well as the technical issue and a volume problem also. But thank you so much on behalf of Auditing and Assurance Standard Board. Chairman of Karnal branch is also there is some technical glitch, that is why he is not able to join. So if still he is there, Chairman sir is not there for the formal vote of thanks.
Hello.
Can you hear me, Chairman sir?
Hello.
हाँ जी, तरुण जी आपकी आवाज आ रही है?
हाँ जी.
जी सर.
I would like to thanks Raghav Singhal ji for their deliberations. Hello.
Yes, sir.
Is
Yes,
I audible?
you are audible, sir.
Thank you.
Thank you so much, sir. I hope there is some technical issue from Tarun sir's side. So on behalf of Auditing and Assurance Standard Board, I extend my heartiest thanks towards the Honorable Chairman of Karnal Branch, C. Tarun ji, for sparing their valuable time as well as hosting this webinar from Karnal Branch side. So thank you so much, Tarun ji, for sparing your valuable time. I also extend my warm thanks to Sri Raghav Singhal ji, the learned speaker for today's webinar, for sparing your valuable time and for his wonderful deliberation, wonderful, detailed and lucid, in a very lucid manner, in a very simple manner, he has explained all the aspects of related party. Thank you so much on behalf of Auditing and Assurance Standard Board. Thank you, sir. Thank you, sir. Thank you, Chairman, sir. Thank you.